Love American Homes Coaching Call Series. Today we have a very special guest, Attorney Roland Wiederaenders, and this is part of the Success Track interview series, and Roland is our guest tonight. Roland was gracious enough to speak to our real estate club last month, and he gave a really great talk on a subject that could go either way, and that's the subject of pooling money and doing it without running afoul of the SEC. You can get in a lot of trouble if you are trying to pull money from other investors and you're not doing it the right way. So Roland, this is what he specializes in, and I know as the market gets hotter and hotter, and right now it's really hot where I'm at, more and more people are looking at doing larger development to be competitive, and they're looking at gathering and pooling money together so that they can purchase and take down some of these larger investments. So what I'm going to do right now is make Roland the presenter so you can actually see his screen, and he's going to walk through this presentation with us, which I think you guys will find really interesting, and it's a great presentation, especially if you're considering raising capital and raising capital from other people. So Roland, I see your presentation. It looks good. All the other folks on the phone, if you could just type in whether or not you see his presentation also. Kay says yes. David says yes. All right, Roland, go ahead and kick us off and get us started. And if you don't mind, I'll go ahead and take some questions from some of the people that are on the call. So if it's okay with you, can I interrupt you at maybe a couple of different times and ask you a couple of questions that some of the attendees may have?
Oh, yeah, absolutely. That's perfect.
Okay, great. And if you could speak up, just because we're recording this, I want to make sure everyone can hear you okay. That would be awesome, too.
Okay.
All right.
Great.
Thanks, Roland.
Okay, well, thank you so much for letting me speak to your group, Shenoah. It's been fun getting to know you and some other people that are associated with the networking club, and I know that you know, this is can be a big part of, and maybe a little bit of a scary part of what you all may be involved with, and but hopefully, you know, what I can communicate to you make things a little easier, or give you some ideas about how you could do things in raising money. But you know, I've titled this pretty conventionally, Top Mistakes in Raising Money Through the Sale of Securities. And here's a little bit of background about me. I'm a corporate securities attorney. I practiced for about 13 years, primarily in Austin, Texas. I don't have a real strong background in real estate law per se, but I have represented clients that have invested in real estate, and helped one client in particular put together a pretty significantly sized real estate investment fund, and have had other clients put together funds investing in real estate. And so I'm a real estate investor myself, and like real estate a lot, and just, you know, again, glad to be talking with you all and getting to know people like Shenoah. And just this presentation, I'd be happy to email it out to anybody that would care to have it. And I guess Shenoah, you know, will have it definitely, and she'll make it available. But you know, this will include my contact information. And at the end, there's a slide with, I guess this title slide has it. But you know, best number to get in touch with me is my cell number there at the bottom, and there's my email address as well. But I'll just go start into the presentation.
Well, hold on.
You know,
before we start, Roland, will you roll back one slide and then roll forward now one more?
Sure.
I didn't realize you were such a badass. I'm looking at all your education here. Plan 2 honors, like, those are the people, like, they are so smart and so good they don't even have to declare a major. So guys, those of you who are listening, that's a pretty big deal at the University of Texas at Austin. and some of your other credentials are quite impressive too. So I guess I missed that last time. That's pretty amazing. So guys, you're listening to someone who's pretty smart guy and pretty sophisticated, and knows a lot about his topic. So go ahead, Roland.
Well, thanks. I appreciate the compliment. This is the area of law that I practiced in for a long time, and so I can go on and on, but I always like to think about the people that I'm talking to, and with the networking club, I thought particularly the information would be relevant for them, and I'm sure that the audience tonight is probably pretty similar, but just moving forward, I think about two fact patterns that you might run into. And the first one is where you might be a promoter of investment opportunity, where you're seeking investors to invest in a business entity that you will manage and the investors won't.
Right.
And then the second fact pattern is where you might be on the other side of the table. Somebody's asking you to invest money in an opportunity that they're putting together, and you're going to be a passive investor and just thinking about the issues that are associated with this. It's kind of both sides are two sides of the same coin, but this is really where these issues come up, and we're talking about securities, and just again don't want to insult anybody's intelligence, but want to make this relevant. Securities are stock in a corporation, a membership interest in a limited liability company, partnership interest, and then debt also can be security. And the U.S. Supreme Courts provide a definition that is used a lot when you think about what a security is, and really what you've got is an investment of money in a common enterprise, and where the investor has an expectation of profits that are derived from the efforts of somebody else. And that becomes really key in all of this, and you'll see here in a second why that's the case. This idea of other people's money is real critical, and when you're thinking about this and what the laws are designed to focus on and protect investors and create obligations for the management. And tonight we're talking about private securities rather than public securities. Public securities like a share of Microsoft that you could go into your broker dealer and say, I want to buy 100 shares of Microsoft, and that's a public security. What we're talking about tonight are privately issued securities. So you're forming a partnership or a limited liability company, and you're not going to the SEC, you're not doing an IPO. You just form your business entity with the Secretary of State. Here in Texas, I don't know if anybody is out of state, but
yes, we actually have a lot of out-of-state investors on this call. So if you have some general stuff about people who are out of state, that would probably be helpful too.
No, absolutely. And just when you think about the private issuance of securities, it's just you're not involving the securities regulator in connection with a registration. And when you think about registration, you think about IPO, initial public offering. Mm-hmm. And that's the most common way of creating a public security. There are other ways too, but the private placement exemption is defined in the federal securities laws as just a transaction by an issuer of securities, a company, not involving any public offering. And we're going to talk about exemptions. These exemptions from the registration requirements are really what are key, and what you need to think about here if you're raising money and selling equity interests in a partnership, a company. And then just to qualify, I hate just to read these definitions, but they're pretty important. To qualify for the private placement exemption, the purchasers have to have some level of sophistication. You probably heard the term of accredited investor, and depending on whether you're looking at the state or federal securities laws, you might see these different terms. Sophisticated in Texas, other states use different terms. Sophisticated is a real common term. But basically, you just want to look at the investor and see whether they have some ability to fend for themselves. You don't want
to take someone's last dime.
Right, exactly.
Yeah.
The widows and orphans. You know, you want to ask people to invest with you who, you know, with real estate it's a lot less risky. But if you're talking about a startup enterprise, a startup company that's, you know, doing a consumer product good, a technology startup, you know, it's a different risk profile. But in any event, just because of the possibility for fraud, there's not the oversight that you have supposedly with a public company. You know, the securities regulators are wanting wanting investors in private securities to have a certain level of sophistication so they can protect themselves. And you do have to provide these investors with the type of information that you normally would be able to access with respect to a public security. You know, Microsoft, you can go onto the SEC's website and do searches of all their filings, and you find financial statements, and management talks about risks associated with the investments, and that's the type of information that you'll need to provide your investors in a private offering even. And then, you know, this agreement not to resell or distribute. And then public advertising is a real important consideration here. You can't take an ad out in the newspaper saying, you know, limited partnership interest for sale. We're going to invest in this great real estate opportunity and make you 15% year-over-year return. I mean, you can't take ads out in the newspaper. And one comment that I would have here is that, or you know, for that matter, use a website or LinkedIn or a forum, you know, discussion forum. All of those would constitute the term as general solicitation. And you know, once you start putting it out, advertising the sale of securities like that, you lose quality. You're not satisfying the requirements for this private placement exemption. We'll talk a little bit more about this as we go forward, but trying to make this just introductory still, without going into too many details. But you know, again, you know, just trying to inject a little humor into this. The next slide is very important, and it gives this idea, or puts forward this idea of OPM, and it's other people's money, as you'll see. You see, it's a definition, and you know, I'm kind of literary minded. I like writing. I like, you know, putting together words, and I really enjoyed this quote here. It said this acronym OPM is equated with its homonym opium and its narcotic power on people who forget that OPM, or other people's money, represents an obligation that must be accounted for and repaid in some way. So you're going out there and you're asking an investor to give you money to go invest in this great deal that you're putting together, but you can't forget that it's his money, it's not your money. And he's, you know, if things go great, you make 15% year-over-year return. You know, after 5 years, you're giving him twice his money back. He's not going to be having any problem with that. But you know, inevitably, I mean, through your best efforts, you may make mistakes, and you wind up, you know, losing some or all of an investor's money. He's going to say, you know, what happened? Why did you lose my money? And that's one of the most important things in thinking about this, is especially when you have an investor that's an unrelated third party, you know, friends and family, people giving you money, you know, having those relationships. You may be questioned less when you make a mistake. But if you're really going out and you have a professional investor, somebody that you don't necessarily have a long-standing relationship with, I mean, they're out there, they're trying to make money, and they're giving you their money with the anticipation of making profits from that investment. And if you don't make those profits for them, if they feel like you've been negligent, intentionally defrauded them, you know, you're going to get sued. And what I tell clients is that anybody can sue anybody for anything. And so no matter how right or wrong their case is, you know, you would still have to defend it, and it costs money. And there are ways that things that you can do to avoid that potential liability when you're putting together your deal and selling securities, and then just how you operate the company. We'll talk about those things here in just a second. But this is a really important concept.
Does that create any sort of fiduciary duty?
Right, exactly. And that's the thing, that if you're a promoter of securities and you're the management, you're in management of an enterprise where you have these third-party investors that aren't taking part in the management the enterprise. You're a fiduciary, and that's a very high standard of care that's imposed on you, and you have to place the interests of your investors ahead of your own, definitely, and just the way that you discharge that duty. One of the most important concepts here is disclosure, and we'll talk about that a lot here. But that's absolutely right. You think about the fiduciary duty and what a high standard of care that is. So we touched on this a little bit, but you've got this separation between the ownership of the entity, the investor, and the management control. The investors are entrusting management, you, with the control over and use of their money. And again, like we talked about before, when things are going well, nobody's going to ask any questions. But when there are problems, the owners are going to want answers, and they'll look to you for those answers. And so,
right.
In thinking about this, this is really key. And the best way to avoid problems with your investors are through disclosure. So up front, defining expectations through adequate and continuous disclosure, both before you before you take their money and going forward. So you've got this investment opportunity, an apartment complex, and you're raising $1 million, and you're taking, money, this $1 million from 3 investors, and you're going to go out and you're going to tell them, this is what we're investing in, this is the amount of debt we're going to use, this is the work that we have to put into it. You just describe the investment opportunity to them, and based on that disclosure up front, they're going to make a decision whether to invest with you or not. And you have an obligation to tell them all the good and the bad. You're going to have to clean up all this nuclear waste. It's built on top of a Indian burial ground or something like that. I mean, you have to tell all the good and the bad, so that they know. These are the costs that are going to have to be incurred in connection with this. It's not all sunshine, roses, puppy dogs. I mean, there are some problems with this investment, but the management's making plans to fix those problems, and this is how they're going to use your money. And then, deal terms are really important, and then compliance with all applicable laws. I mean, you follow those three general guidelines, and you're going to be in good shape. But of course, devil's in the details. So we'll just go into the mistakes. First thing I think about is choice of entity, and when you're thinking about this, you've got different options: limited liability company, partnership, corporation. And why use an entity in the first place? You probably know you have this protection, this liability protection, so that as long as you're acting in good faith in connection with your management of the business enterprise, any liabilities that you incur, the people that might sue you can't come after your personal assets. The maximum liability exposure that you have would be in connection with the assets of the enterprise. They can't come after your retirement account, your investments and other assets. It's just your liability is limited to the assets of the business. And it's just that's why you would form a business rather than operating through a sole proprietorship. It's just liability protection. Mm-hmm. And with real estate, you could potentially hold real estate as tenants in common. You could have 20 people on a title theoretically, but it just gets to be a mess, and it's a management issue. And you put all those 20 people into a company, and what's that?
And if someone dies, I mean,
I
know you make provisions for that, but still, I mean, that still can complicate things.
No, that's absolutely right. I mean, just a whole host of issues there. But I think about putting together an investment vehicle to invest in a real estate deal, and I think limited liability company just generally as being the preferred entity type, the most flexible. Different things that you can do with that. In the past, there may have been that maybe wouldn't have been my answer, particularly here in Texas. And
it would have been the LP.
Right, exactly.
Yeah, because the franchise tax issue, that's no longer an issue anymore. We still invest personally in one of our LPs just because that's how we started, and we've just stayed with it, even though the advantages are no longer there.
and each state, may have its own issues, and that's one thing that you'd want to look at is that in Texas it used to be that you could form a limited partnership, and it was just a quirk in Texas law that you wouldn't be subject to a state-level income tax.
Mm-hmm.
Every other entity, a C Corp or corporation, limited liability company, you pay a state-level income tax, but not a limited partnership. That's not the case anymore.
Right.
And generally, I would say form the entity in the state where the project is located. So if I'm advising a Texas client, they want to put together a partnership to buy an apartment complex in Austin, I'm going to tell them form a Texas LLC instead of like a Delaware or Nevada. And you're thinking there again about state tax issues, and we'll look at the next slide here in a second, but I'm kind of jumping ahead. But even Delaware and Nevada have franchise tax or business license taxes, and in Texas, there's an exemption with respect to the first $600,000 of income. So, a lot of states are probably like that. If you're talking about a relatively small, like $1 million deal, then you may not be able to may not have to worry too much about your state level income tax issues, or there are planning ways that you can plan for that as well. Just for the sake of simplicity, ease of administration, what makes sense probably is an organization that's formed in the jurisdiction where the project is located.
So we had a very lively discussion about this when you presented to our real estate club, because a lot of people have the misconception that, I want to form it in Delaware or I want to form it in Nevada. And can you talk to, doing that even when when the investment is in another state?
Right. And again, this is one of those areas where what's done in practice and what the law technically says, may diverge. But, just using Texas as an example, if I form a Delaware entity that owns an apartment complex in Texas that I manage here, let's say all my investors are here, just technically that all the income that you would derive from that is there's this concept of nexus where it's Texas sourced or Texas connected income. Technically, even though that Delaware, you form this entity that's a Delaware entity, that it's not a Texas entity, you're still liable to pay taxes on that Texas connected income, even as a Delaware entity. And but a lot of people will form that Delaware entity and they'll say, I'm a resident of the state of Delaware and I don't pay taxes, and they don't report it to the controller, and the controller may never know. In Texas, when I say controller, that's the Texas the taxing authority, the business taxing authority in Texas, the comptroller. And then you rely on the fact that they don't have the same resources to go out and investigate, who's doing business in Texas, what foreign companies are doing business in Texas, or are you liable for this franchise tax? But again, the technical rule is that you're supposed to report that income as Texas sourced income and pay taxes on it to the controller if you're liable.
Well, and there's also an issue that now, you've got to stay abreast of the laws, rules, regulations, et cetera, in multiple states, even though you're just investing in potentially one.
That's right, yeah.
And so you may have to employ, attorneys, in those states as well, which can, turn something that was supposed to be a savings into, possibly a very large expense.
Yeah, that's right. You have to think about the administrative complexity of what you're setting up, and you may have to wind up incurring all these costs that are just not necessary and cut into the investment return, what you're going to be able to pay back to your investors.
Right.
So going forward, looking at who your investors are, and we touched on this before, and I think about this in terms of liability, that knowing who your investors are and what their background is, a professional investor maybe is going to be less of a problem for you than a friend or a family member that's investing with you, just because they understand how an investment in a partnership works. They've done it before. You know, they know how to think about the risk profile of the deal that you're bringing to the table. And again,
do you see a lot of family partnerships go bad? I mean,
well, you know, is
that why you say that, or?
Well, no, I mean, I think about, I mean, I put this up there, the 80-20 rule, and you know, of course, like a family member, friend investing with you, you know, they're going to extend you a certain amount of grace, but I think that if you're dealing with more sophisticated people, you're probably going to wind up having to spend less time with them, you know, and you're going to be able to devote your energies to managing the business and extracting as much money out of whatever the project is as possible, rather than explaining to somebody, you know, the just very basic concepts of how LLC works, you know, or just. And I mean, you've got that obligation to maintain good relations with all your investors, but you know, and you think about too. Well, if I want to raise $1 million, do I want 2 people bringing in $500,000 apiece, or do I want 10 bringing in $100,000 apiece? And you know, I'm going to be spending all my time on the phone with the investors, telling them about what's going on, rather than going out and managing the deal. And
I
so
was actually at a presentation today with another local investor who is, you know, completely set up to raise capital. You know, I guess, do you call it you're licensed through the SEC, or you're accredited through the? I mean, what's that terminology?
Oh, like a broker dealer, or somebody that's
no, like, you know, they were set up with the SEC, so they passed all the criteria.
Oh, right. I mean, I guess, you know, you think about registration with the SEC.
So they're registered.
You know,
okay, yeah. So one of the things that he did is he actually had 2 different investment companies, one that was registered with the SEC, that was one LLC, and then another one, he did not say whether or not it was registered with the SEC, but he was taking investor investments at as low as a $1,000 initial investment, which I thought was crazy, because administering that, you know, administering, you know, a $1,000 investor sounds like, number one, a pain in the butt, and they're probably going to be the ones that actually are calling you more than even your $100,000 investor. So I thought that was strange and interesting, and I think, you know, you said it here, you know, the 80-20 rule with too many investors. Now he's got so many more people to answer to, and they're not investing at the same level that his, you know, his other group is invested at. So I thought that was interesting, and it sounded like it's going to bring him possibly some trouble at a later date. I don't know. Yeah,
no, I'd say that's definitely. I mean, that's a real strong consideration, and yeah, you know, it's just sometimes you need the money, and maybe you don't have the flexibility of limiting it to a smaller group, but you know, just going through a deal where you've got this large group of people that are asking you these questions about what's going on and angry, and you know, each additional person raises the likelihood of getting sued. And I hate to focus so much on the negative side of it, but you know, again.
Well, this this presentation is about understanding the risk. So, you know, I actually do appreciate you addressing that. Roland, do you ever get involved in any of these lawsuits, or do you hand those over to someone else? Do you just focus on more setting an investor up so that they can raise capital?
Yeah, I've been involved in a lawsuit. I've never been sued personally, but I have had a client that was sued for securities fraud, and I've been involved representing people, not directly, but you know, if it gets too far off down the road, I'd probably get a good litigation attorney involved. But you know, I've handled this one securities fraud issue for a client, and you know, it was over a disclosure issue. They asked investor for money at a time when there was this liability out there that they didn't know about, and the investor said, "Oh, you should have told me about that." And the client said, "Well, we didn't know about it," and but it was, it was a dispute over.
That they should have known, maybe.
Right. Yeah.
Sounds
exactly.
like, yeah.
And so, I always think about that whenever, just whenever you're taking the money in, and at the beginning of the deal, everybody's optimistic and thinking, "Oh, this is going to be great. We're all going to make a bunch of money." But you got to see those people as potential plaintiffs.
Right.
So just going forward, we're talking about these accredited investor standards, and again, we're relying on this private placement exemption, and at the federal level and in most states as well, you're going to have the easiest time of it if you're dealing with people who are accredited investors. And this is a definition from the federal securities laws, and you've probably heard of it before, but it's somebody that has an individual with $1 million net worth, individually or together with their spouse, exclusive of the value of their principal residence. And that's a little bit of a change over the last couple of years. It used to be that you could include the value of your home.
That's probably a smart exclusion.
Oh, right, exactly.
Because home values in California, when they doubled, it didn't necessarily mean that person should be classified as an accredited investor. They may or may not have had the experience, so it's probably a good exclusion.
And then you'll see these income tests, $200,000 individually or $300,000 together with your spouse. And so, this really does bring us into these specific exemptions. And if you've ever heard the term blue sky laws, I mean, those are just the state securities laws and U.S. federal securities laws, and you have to follow both of them. So you think about following the U.S. federal laws that are administered by the SEC, and then each state has its own securities regulator. In Texas, it's the Texas State Securities Board, and there are these these rules regarding the exemptions from registration, both at the federal level and the state level. And now, over the last 15 years, 16, 17 years or so, following the federal law is pretty much going to keep you in compliance with the state law. So focusing on the federal level here, you think about Reg D offerings. Have you ever heard Regulation D? That's a regulation that's issued by the SEC under the federal securities laws, the Securities Act of 1933 specifically, but the Rule 506 is probably the most commonly used exemption. And it just allows you to raise an unlimited amount of money from investors, and there are other rules that would place a limit on the number, but just at least under these laws, there's no limit as to the number of investors you can have as long as they're accredited. If you have an unaccredited investor, you can only have up to 35 investors using that particular exemption. But compliance with the federal securities laws begins with filing a Form D with the SEC. Form D is a form that provides disclosure about the entity, the name of the entity, the individuals who are involved with management, where the entity is located, the types of securities that you're selling, whether it's stock, limited partnership interests, limited liability company membership interests. Again, who's involved in the management, the amount of that you're selling, and these are searchable documents now. You can go onto the SEC's website, and in a private deal, if somebody's complying with the securities laws, they're bound to file this Form D with the SEC, and it does provide you with a certain degree of disclosure. And again, that's the key concept, what we were talking about before, disclosure. I'm
actually pulling
and then
this form up right now. So, do you see people who actually do this themselves?
You can. I mean,
I mean, I wouldn't recommend it at all, but
yeah,
I mean,
no, that's right.
it's an 11-page document of, that's basically all fill in the blank, and of the 11 pages, it looks like maybe only 6 to 7 pages you actually write something in.
No, that's right, and it's relatively simple form. And you're talking about filling that in, and if you know how to do it, I mean, it takes me about 10 minutes to do that for most clients. I mean, the most of the work is really in creating all these other documents that are associated with what we're talking about. But, that aspect of it is pretty mechanical, pretty simple.
So guys who are listening on the phone, I just Googled SEC Form D and basically went straight to it. So you guys can look it up as well and kind of review it if you'd like to kind of know what's, some of the things that you have to think about in advance of doing raising capital with other people.
And one thing that's really important here is at the federal level and at most states, you've got this 15-day deadline, so that you have to make this filing within 15 days of your first sale. And the sale is defined as taking money in from your investor. Once you deposit their check in the bank account, that starts the clock running. And
now, Roland, does it matter if you only have one investor versus 20 investors based on whether or not you should go through this process?
There are different exemptions that you can rely on, and so we're talking about this Rule 506 exemption, and there's just the statutory exemption is down at the bottom here. We're looking at self-executing exemptions.
Okay.
Under 4.2 is a section from the Securities Act. But, it may be that if you have just one investor, you think, you're really controlling all the facts of how the offering is made, how the deal is put together, all the contacts that you've had with them have been via email, and so you can really show, yes, we never went out there and made all these promises to them or gave them a bunch of written materials. So I mean,
at that point, if it's only one, would you just say, why don't we just give you a first lien and we'll sign a promissory note?
Right, exactly. I mean, trying to structure it in as simple a way as possible, I think, is always going to be to your best, in your best interest. But the simple answer to your question is whether you have one investor or 100 investors, these same laws apply. But it may be that just because you have that one investor, I might say, okay, as we talk about it now, we could maybe save you some money. I mean, it's free to file the Form D with the SEC. You have to pay fees to the states. Like with Texas, it winds up being like $300 at least. So there's a cost associated with it there, but it does give you some additional protections. But there's ways to do it without these filings as well, and that's why you for better or worse have to talk to somebody like me to tell you about your different options and what's going to be the cheapest, but also is going to give you the most protection. And then sometimes you would, even with one investor, you'd want to file a Form D with the SEC and with the state. Think about complying with the laws of the state where your investor resides. So if you have a deal that's going on in Texas, but your investor is in Oklahoma, you have to look at the Oklahoma securities laws. But again, there may be instances where we can do this without making a filing with the SEC, and it makes sense. But just kind of talking here about the safest way of doing things. Right.
No, that's good.
And so, going forward, I mean, advanced disclosure, and when you're putting together a deal, again, we talked about it before, you're going to provide disclosure to your investor about what it is that you're doing. This is the great investment opportunity. We're going to buy this apartment complex and get it leased up, do rehab, whatever it is to increase those rent rates, and going to drop the cap rate, increase value. going out and telling people how it is that you're going to be doing that. And it's, you know, one thing to say it to them orally. I give you, you know, just we meet over lunch, but then I start putting things into writing. And you know, when I think it's always a good idea when you're going out and you provide people with this disclosure document, some kind of summary of what it is that you're doing, and you can draft a 50-page document called an offering memorandum that gives, you know, disclosure ad nauseum and talking about risk factors, or it can be something that's really short and sweet and with respect to if you're raising money to buy one asset, then it's going to be pretty simple. You know, this apartment complex is located here, and you talk about disclosing all the good and all the bad about it, and why you still, you know, even with all the bad, why you still think it's a good investment opportunity for your investor. But with this slide, really the thing that you should think about is this statement here that's underlined, is that you've got an obligation to not only disclose all the material, anything that's material to your investor's investment decision, all the facts. So, you know, this is the cost, this is the price, this is these are the taxes, utilities, you know, these are the repairs we're going to have to make. But you can't leave anything out. You know, you can't just say, you know, fail to tell them that it's built on an Indian burial ground, and just think. I mean, that's something that somebody that's thinking about whether they want to. You keep
bringing up the Indian burial ground. Do you know something that
no,
I don't know yet?
No, there's just, you know, nuclear waste, whatever it is.
Sure,
you know,
sure.
You have to. You can't remain silent and just think, oh well, you know, and it's just this. You know, the violation is a failure to, or making any untrue statement of a material fact, or omitting to state a material fact necessary in order to make the statements made in light of the circumstances under which they were made, not misleading. So it's just disclosure, essentially, and it's telling people what's going on and not failing to tell them something that would be material. It's not failing to tell them something that you know they would really need to know to make their investment decision.
Right, right.
You know, again, we talked about offering memorandum, the deal summary. Risk factors are really important. You know, you want to tell people, you know, the indebtedness that we're incurring in connection with this deal has a adjustable rate. You know, after 5 years, the rate's going to reset, and who knows what's going to happen with interest rates 5 years down the road. And you know, if they go through the roof, then we could be totally, you know, a huge problem for us. We won't be able to make our debt payments, and that's a risk factor that you would want to disclose to your investor. And I mean, there are lots of risk factors. You know, you think about the availability of credit, or, you know, we may need to raise money in the future, and the money may not be out there available for us. And then again, you know, just this idea of just putting together a marketing presentation to provide this level of disclosure, telling people what it is that you're going to be doing with their money. And here, you know, I've represented investment funds in the past where you'll have a partnership that you're investing in, and they're going to give you a general description of all, you know, the strategy that they're going to employ, but you don't know. It's like a blind pool. You don't know necessarily what they're going to be investing in. And so you think about doing, you know, selling securities, forming entities on a deal-by-deal basis versus creating a fund. That's maybe not that big of an issue for most of the people in the audience tonight. But one thing that you do think about is the language that you use in your disclosure documents and how you talk to your investors. And you don't want to use puffery. You want to use language that reflects the uncertainty of future events, that you think we're going to make all this money, but you can't say you're guaranteed 15% return. You say, we believe that this is a good investment opportunity. We anticipate that market conditions will, you know, improve, and over the course of 5 years we'll be able to sell this for twice. You know, but you're saying, you're not saying definitively that that's what will happen. And then here, one of my clients said, this is weasel language. It's lawyer language. It's like, well, we think that this is a good investment opportunity, but there are no guarantees. You want to go out there and sell the deal and use this powerful marketing language, persuasive language to convince people to buy into your project. But when you're getting in front of investors, you also have to think, well, what if something goes wrong? And you have to tell them, this is what we believe, but obviously there are no guarantees. It's a balancing act. You'll see past performance is no guarantee of future success. If you're going out there and trying to convince somebody to give you their money, and you've put together 20 really successful deals, I'm going to tell you to put this language in whatever it is whatever written documents that you put in front of them, because if you don't, then they're going to say, well, you had these 20 successful deals, and now, this one that I've invested in, it failed. You've returned 15 cents on every dollar that I invested, and I'm going to go to the language and say, look, my past performance is no guarantee of future success. Disclosure of tax consequences, that's something that's really important. If you're talking about an entity that's taxed as a partnership, this is one of the most important things that you should tell your investors, is that they may receive allocations of income that is earned by the partnership, but there may not be a corresponding distribution of cash to go along with that. And so I could be a partner in a partnership, be allocated all this income that, it's great. I'm so happy. We're doing great economically in this investment, and I'm obligated to report that on my individual return. But
it's a paper gain, but a cash loss.
Right. Yeah,
that's kind of scary. That's kind of alternative minimum taxi. So yeah, that's a big deal. Now, when you talk about distributions, are those distributions typically capital gains? Are they typically dividends? Are they typically normal traditional income?
Yeah, I would say that any distributions generally, during the life of the partnership would be from current income.
Does it matter if the partnership or the LLC has held on to an asset for over a year? Could that benefit them from a capital gain standpoint as opposed to a regular traditional income standpoint?
Right, absolutely. And the nature of the income retains its character at the partner level as it had at the entity level. So, if you've got this current income, you're earning rents, and that's all going to be ordinary income, and it'll be taxed as ordinary income to your partners. But when you've bought this apartment complex in year 1, and then year 5 you sold it, that would be capital. The proceeds from that sale over your basis would be capital gain, and then that would be reported to your partners would report that on their individual return as capital gain.
So now they get a K-1, so would that be reflected in their K-1?
Yes. Uh-huh.
Okay.
Yeah. So, defining the investment terms, again, this suggests that the right way to do this is to hire an attorney. You can go out there and form your own LLC and find a partnership agreement, a company agreement out, form that you find through Google. But if you do that, just make sure that you understand every word that's in that agreement. And you're talking about management issues, who has control over the day-to-day operations of the partnership. What are the economic terms? Are you going to be paying your investors this preferred return, and then all distributions are going to go to them until they get their money back, and then after that there's going to be a 50-50 split? Just whatever the economics of the deal are, you want to define those very clearly, and make sure that you're not telling people that you're doing one thing when actually the agreement says another, or maybe your practice says a third thing. But
Right.
And then
there are armchair quarterbacks and there are Google attorneys, and both are kind of the latter is much scarier than the former, but still.
And then, you know, one issue like capital calls, like really defining expectations and letting people know, yeah, down the road, a year from now, we may need to put a new air conditioning unit in, and we need whatever that's going to cost, another $20,000 from our investors. You know, so you might have to cough up another $10,000, your pro rata share.
Speaking of capital calls, occasionally, probably actually a lot, my guess is that, you know, an investor finds himself or herself in some sort of a financial situation and has to make the call to the, you know, fund manager, if you will, and say, hey, I need my $250,000 investment back, as an example. So is that where, is this where you would discuss that and how that could happen?
Right, absolutely. You know, and you think about real estate being an illiquid investment, that's, you know, we were talking about risk factors before. That's always a chief risk factor. You tell people not only is your interest, you can't go out and sell your interest in this partnership, you know, on the NASDAQ exchange.
Right.
I mean, it's a private, but so not only do you have liquidity restrictions there, but also real estate itself is illiquid. And so some partnerships, you may have a partnership that has several different assets and holds a lot of cash, and you know, you think about something like a public REIT where it's, you know, you can go out and buy the share of the REIT one day.
Overnight. Yeah.
Right, but here, I mean, definitely, and that's one thing that you really want to, you know, the real estate investment fund that I represented, they offered investors outs. You know, you had to give them 360, I mean, a year's notice, essentially. I want my money back. But at the end of that year, you know, they would figure out how to manage the cash and maybe sell an asset.
Or maybe find another investor, right?
Right, exactly. And so, you know, but again, I mean, just really telling people, look, your money is going to be tied up 5 to 7 years. We have an option to extend the term of this partnership for additional year after year 7 or 2 years, and so, you know, you don't want people coming back.
Especially with this last real estate downturn, my guess is that some of those extensions maybe lasted, you know, 5 years or more, right?
Oh yeah.
So you really have to be careful with that, you know, because when the market's hot, sometimes people don't think about it, but the market can cool and slow and come to almost a complete stop, almost what feels like overnight. And if you only have a 5-year term and then an optional 1 year on top of that, you know, you may not time the market right, and you could find yourself, it seems like, in a lot of trouble. So my guess is when you're writing these today, are you making those, I guess, I don't know if it's like a renewal provision. Are you extending those longer, or how are you handling that?
Well, it's just, you know, predicting the market, I mean, is always just nearly impossible. And I guess what I tell people is that it's going to be pretty unusual for you to be able to convince somebody, you know, no matter what the market conditions are, to give you their money on an indefinite basis. So you have to define some kind of term, and you want to give yourself as much leeway as possible. So, you know, I guess where I would start out with, you know, saying is most commonly used term with respect to something like real estate is something like a, you know, 5 to 7 year term with additional, you know, 1 year extensions at the discretion.
So you're baking in that risk and just kind of having that longer initial term.
Right.
Okay.
And then I'll also say, but even after that, you can go back to your investors, and if a majority of your investors consent to extend the term for a longer time period, then you can go longer. And I think, you know, when you, again, this notion of disclosure and always going out to your investors, letting them know what's going on and the good, the bad. I think if you've got good relationships with all your investors and you've been talking to them about what's been going on in your deal. And at the end of 5 to 7 years, you're coming to the close of that term, and you tell them, look, these are the market conditions. We should hold on to this for another couple of years. We're break even. We're cash flow positive every year. It's not as much as we would have liked, but we think that the market is beginning to turn around if we hold on to it for another 2 years. Please give us your consent to do that, and we think that you'll be very pleased at the end of that extension. And again, I mean, it's
you're managing
investor relations. Yeah, exactly. Managing expectations. That's it.
And that's, I think one thing that I see a lot, so as a realtor and a broker, I see a lot of, realtors take a listing and then just disappear off the face of the earth. And my guess is that there are probably, a similar number of people who are taking other people's money and then disappearing off the face of the earth, which is kind of a little scary. So,
well, I'll tell you a story with this one client. I mean, make this short and sweet. This one client that I was telling you about lost all their investors' money. It was primarily due to a fraud, but the investors threatened to sue, and the one investor did sue actually, and we settled that pretty early on, but wound up not getting sued at the end, even though we lost, or I should say the management team. I was their attorney. I wasn't involved in the management of the real estate, but didn't get sued at the end. And I think that the reason why we didn't is because we're very diligent, faithful to, on a monthly or at least quarterly basis, to go out, have a conference call, and tell people what was going on, the good and the bad. And I think that that's the most important thing, because I think people that, the mystery, I have no idea what's going on. I think most people would probably rather hear the bad news than be left to wonder. And so that's one thing that I would really emphasize here, is that disclosure ahead of time, before you take the money, and then after, continuing to talk to your investors and telling them what's going on, both the good and the bad. And obviously you want to instill confidence, but you also don't want to mislead. And it may not be a lot that you can really do. It's not like you could say, we'll sell it and we'll give you your money back, or you might be able to do that, but at least just telling them, yes, we've had this issue with the foundation, we have to get it repaired, whatever it is. Just telling people what's going on, what's happening with their money, that you're having to account for at some point in the future.
So on that particular deal, you said there was fraud involved. Was it fraud on the part of the person who initiated the offering, or was it fraud on someone that those people hired?
Oh, it was fraud from a title company, actually. The fund was involved in transferring a property, and money got stolen from an escrow account in California. It was just a really horrible circumstance. But, was it like I think, was it Summit? Was it like a 1031 exchange? No, it was just a financing arrangement that this fund had entered into with this joint venture partner, and it was really just using this escrow company where their money was supposed to be housed for a very short time period, and it just got wired out by a rogue escrow company employee. And they weren't able to get that money back? No. I mean, we wound up suing the escrow company. It was undercapitalized. It was kind of a long, ugly, sad story.
But they're regulated by the Department of Insurance, right?
Well, in California,
in their state.
Right. Yeah, and it's just the bonding requirements. I mean, I can give you a long lecture. I learned a lot about the types of escrows in California and the different bonding requirements with respect to each, and just all the horrible things that happen in connection with that.
What's crazy? You just assume, they're a title company, and then you just, I would just assume that, actually, there was one title company that I dealt with that I was actually afraid to wire money to, But other than that, I mean, literally, I have just made the assumption that title company, you know, good, check. I can send them my money, and I can feel safe and secure.
Yeah, and I mean, just you know, without belaboring this too much, I mean, it really had to do with the type of the escrow, and I think with most escrow companies, the bonding requirements with respect to sales transactions, escrows with respect to sales transactions, you're going to be pretty safe. That this was just a little different, and the bonding requirement was a lot less, and that's where we really got caught. But you know, just in the downturn, the fraudsters really came out of the woodwork, and we got caught. This client got caught.
Right.
But just you know, I mean, it's a lesson, disclosure, and we were talking to our investors enough to where they said, yeah, that really stinks, but we believe that you guys did your best because you've been out talking to us on a regular basis and telling us, you know, these are the decisions that we're making. This is what we've done with your money. You know, this is the good, this is the bad. I mean, I think that, you know, you developed this sense of trust with your investors.
Right.
And even though these horrible, bad things happen, I think at bottom they trusted us that we, you know, the management team at least, again, had
So they decided not to sue you, which, you know, I mean, not you, but your client. Was it because your client didn't have any other money, or I mean, like, you know, I mean, because it seems like if your client had money, they probably, even though, you know, yeah, it's a bummer, but I still need to get my money back, you know.
And that's one thing that I think is really important.
Did they go after you as like a civil suit or a criminal suit against the title company? Did anybody do that?
Yeah, well, there were a couple different law enforcement agencies looked at it, and they determined that there wasn't enough evidence. And they said, you know, this is really a civil matter. I mean, the title company just said.
So they determined it wasn't a criminal matter, that it was a civil matter.
Right.
Okay.
And so we did sue them. We wound up winning the lawsuit, but it was the company was still undercapitalized. It didn't do us any good. But I mean, I guess
did this person like run off to Mexico? I mean, I hate to belabor this, but did it just like leave the country, or?
Yeah, they, you know, the money went out to about 10 different people, you know, relatives and companies, and he had a partner in crime that it went out to. Some of it went out to him and some of his friends and out of the country. So it just got thrown to the winds. And
fascinating.
But you know, to go back to one of your points before that I think would be really relevant for this audience is that when our investors were making the decision whether to sue, they were looking at the principles. And the reason why we talked about limitation of liability before, and why you always operate your business through a business entity rather than just individually in your own name, which you certainly could. But you know, we said your liability is limited to the assets of the business, but that doesn't include instances where you've defrauded somebody, and then securities fraud. When I've gone out there and told you, you know, I'm investing in this apartment complex, when really I went out and I took the money to Las Vegas and lost it all playing blackjack. I can't hide behind the corporate shield there because I've lied to you. I've committed a fraud, and so in that instance, I could be held personally liable for that action. And again, you know, with this example that I was telling you about, because of that personal liability that's there, and this is very important for this presentation, there's a slide about this later on, you know, you have to think about that, your individual liability. And one of the principles of this deal had some pretty significant assets. And the investors still decided not to sue because I think, again, at the bottom, you know, they believe that while there were mistakes involved, there wasn't fraud, and they trusted, you know, they entrusted this client with this money, and the client made mistakes, and but that's really key, you know. And when you think about securities fraud, that individual liability that you can have is is something that's really a big consideration in when you're thinking about complying with all the securities laws, like what we're talking about. We're talking about this deal terms, and I'll just kind of move forward. I mean, I think that this is actually, I think, what presentation tomorrow night is going to be talking about a little bit. But making sure. I mean, the thing that I hate is when a client will come to me and say, we need this partnership agreement for this deal that we're working on, and I send them a draft and tell them everything that they need to do, and then I hear from them 3 weeks later, and they say, "Oh, we got the money from our investor," and I say, "Oh, that's great," and they maybe even gone out and bought the property, and say, "Well, could you send me a copy of all the partnership agreements and all the documents that you had signed up?" And they're like, "Oh, we haven't gotten those signed up yet," and oh, by the way, we changed some of the deal terms too, and it's just, you think about the formal closings that you have at a title company. I mean, it's smart because all those documents are signed simultaneously. They set forth the terms of the conveyance and the loan and the definitive deal terms, and that's really what you should think about if you're going to take somebody's money. You should think about likening your closing in that deal to a closing at a title company where it's very formal, and making sure that every document.
That's a really good way to think about it. That's a really smart way to think about it.
Because with any issuance of securities, you're going to get your investors to sign on the dotted line in a couple different places, and you're going to be signing documents in a couple different places, and you have to make these filings with the state and maintain your corporate records, your minute book, and you're going to maybe have to present these documents to a bank down the road to show that you did everything correctly and that you've got authorizations from all your investors to do whatever it is.
So all the investors really walk away. I mean, so basically they got the check and the investor didn't walk away with any, deal form, any memorandum, anything?
Yeah, right. I mean, they'll have a draft of the partnership agreement sitting in their inbox, and maybe they've looked at it, maybe they haven't, but it's scary because when things go wrong, they're going to say, well, you took our money without signing partnership agreement. You can go back, you can fix it, you can go sign those agreements.
Right. So do you give that investor I guess you give the investor a copy of the new agreement and hope that they don't say anything, and if enough time passes, then you might consider yourself safe?
Right, exactly.
But do you have them sign? Do you have them sign like, yes, I've received a copy of this, and yes, I've read it, and sort of go through that sort of a thing too?
Oh, right, sure. I mean, getting their signature is the most important thing. But I may tell the management, look, write a letter to them and just say, as you know, we took your money this day. We didn't get documents signed. We made these changes subsequent to the time. I mean, just again, disclosure, putting something in front of somebody in writing, and it just prevents them from coming back later and saying, oh, I didn't know that you were doing this with my money, or, I mean, that's really, being able to point to this document saying, oh, yes, I did, look on page 3 here. We did exactly what we told you we were going to do. So, this is, again, this continuing disclosure notion in investor reporting and giving them monthly letters. It may not be appropriate for an apartment complex for you to write a letter every month to your investors and saying, this is what happened last month, but just maybe once every 6 months telling them, these are, we've done this with the rates and the occupancy and made these repairs and done this refinancing. But just, again, going out in front of your investors, going out to them and telling them what's going on. And again, it's this balancing act between too much and not enough disclosure. But I always think over disclosure.
I agree.
To the extent that you're not giving away some kind of secret sauce, secret formula, you're your proprietary management techniques. I mean, tell people what's going on. And
well, speaking of, do you have them sign a non-disclosure or non-compete? Well, I guess you couldn't really have them sign a non-compete, but I mean, is there anything that I guess you would have them sign a non-disclosure when you first pitch them, or?
Yeah, and you think about right. I mean, that's something that you definitely should think about. If you've got a deal that maybe a couple different people are looking at, and you may think, well, I'm going to take this to an investor, but they may get the idea that they're going to go and buy it themselves. Maybe you don't have it under contract. I mean, that would be maybe kind of stupid for you to do that, but just whatever it is. I mean, that's definitely an option. And
people do that all the time, though.
Right. And so,
how quickly? So let's say that you're putting together a deal. Like, I got a call on a deal today, and it's for I got a call for a $2.5 million property in San Antonio that's commercial property the other day. And if I called you and said, holy crap, I've got this great deal, I know it's a great deal, but I need to raise some money to be able to do it, how quickly could you get me, safe, secured, and SEC ready?
Right. We know it's good, fast, and cheap, or expensive.
Yeah, you get to pick
any two.
Yeah.
So we could do something perfect overnight, but it's I'm going to stay up all night and I'm going to charge you premium rates and everything. But you can get something put in place temporarily. I mean, it just kind of depends, but you can form an entity in most states within hours. Some states will charge you fees.
But I mean, I guess so. You could tell me, like, a week is a week reasonable?
I would say so. Yeah.
Okay,
I mean, if you have everybody focused on it, your investors are ready to go, ready to write the checks. They kind of understand what they're expecting in terms of.
By that time, I would expect I'd have a relationship with these people already, but now I want to formalize it and make sure that I'm covered, and make sure my deal is covered. Right. Okay. All right. That sounds good. That sounds totally reasonable. Totally doable.
I mean, that's aggressive, right? You have to have everybody focused, and most of the time, it's not going to be the attorney's fault. It's going to be somebody goes on vacation or.
Sure.
That's really what gets my juices flowing personally. I think about helping people do what it is that they want to do in their business, and I think, gosh, we've got to get something done by tomorrow, then I'm going to stay up all night to help you do it.
How often do you pull an all-nighter?
It's been a while. Really,
it's kind of like you're back in college.
Yeah, exactly. It's that adrenaline.
Right.
So I don't know. I guess. So I think we talked about everything on that slide, and number 9, inadequate ongoing accounting, financial reporting, tax reporting, providing people with financial statements, thinking about whether you want to have those audited. Maybe not. For $1 million deal, maybe you don't get audited financials.
What percentage of your clients actually do go through the auditing process, and do you know approximately can you tell our people approximately what that cost is?
Sure.
For example, a $10 million deal.
Yeah, I mean, I would think that maybe, and you might know this too, but I would say that on something like that big, you might pay $10,000, $15,000 for an audit.
Okay.
Maybe that's a little high, but I know, with some of the funds that I worked with, the audit is expensive. It can be very expensive, and maybe not worth it. It cuts into your investment returns.
Right.
This is the kind of thing where you think about, well, what do your investors want? What do they expect? What's your relationship with them? And if you can sell it without telling people that you're going to have audited financials, then it's probably the way to go. Not because you want to hide something, but
right.
you'd rather use that $5,000 for whatever instead of paying an accountant.
And you'll still have a bookkeeper and a CPA, preparing the, handling your monthly statements, et cetera, and then preparing your K-1 at the end of the year. So, it'll still have some oversight, professional oversight, but it just won't go through necessarily an auditing process.
Right, exactly. And that's a good balance. You know, you say, well, I've got this independent accounting firm, and we're not going to pay them the fee to audit our books, but they are engaged in preparation of financial statements, and that would give an investor some degree of reassurance.
I mean, because over a 7-year period, which is what a 5 to 7 year period, which it sounds like is what you're writing into many of these. Is it okay to call them agreements?
Oh, sure, yeah.
Okay.
I mean, yeah.
So, I mean, that could be $50,000 to $70,000 that's taken out, which is not insignificant.
Right. Yeah, that's exactly right. And then, the tax reportings, I mean, telling people, yes, I'll get you the K-1 in time for you to file your 1040 by April 15th, or no, you're going to have to, every year, I'm not going to be able to get that to you for whatever reason until June 30th.
Right.
And you're going to have to file an extension, and just letting people know up front what they can expect, and
something funny. So for me personally, I just wrote my big check to the IRS on Monday, as did probably you and most of the other people who are listening, and I filed a form, 4868, which is the extension, but you pay. And I was actually about to create a new LLC with one of my partners who I happen to do a lot of deals with, and we were just going to create an LLC, a new LLC, just so we could, have those deals separately, and each person could sign for anything that we go under contract for. And they told me, gosh, Shenoah, I know that you don't, ultimately, finish all of your tax work until, the mid-year or even late year. And our son is getting ready to apply for college, and we're going to apply for some financial aid. And if we do that, when we do that, every single year we have to have all of our taxes done by April 15th. Including you've got to get the K-1s over to us and everything like that. Yeah. So I thought that was really interesting, and my guess is that a lot of people probably are with the cost of college being so ridiculously high. I'm sure that's in some cases can be quite a consideration for some people, even sophisticated investors like the ones that we're talking about, investing in some of these deals.
Yeah, and I mean I just can't imagine that. I'd imagine for a single asset deal, and in a lot of instances, it's not going to be a huge issue. But the funds that I was involved with, they would tell people, yeah, you're not going to get your K-1s in time by April 15th. I mean, we're not going to be able to get them to you by then. You're going to have to file extensions, and
right,
that's not uncommon.
Right.
So. We touched on this before, failure to understand consequences of violating securities laws, securities fraud remedies. Again, individual liability, we'll talk about that in a second, but rescission is a concept that you may or may not be familiar with, but one of the ways or one of the penalties for violating securities law is this idea of rescission. What that means is that I have to make you whole. So you've sued me for whatever the security law violation is, and it could be something as innocuous as me not satisfying the requirements of my exemption that I was relying on. I didn't follow the Oklahoma securities laws, and I didn't do anything, and I was supposed to, and so you're suing me now for whatever reason. But one of the allegations that you make in your complaint is that I violated the Oklahoma securities laws, and a remedy for that, that's what attorneys call solutions. A remedy for the plaintiff is this rescission, and so me, the management of this partnership, I would be obligated to pay you back your $1 million investment plus interest at a statutorily defined rate for the term, however long you had made that investment. and that's regardless of what happened to the assets of the partnership. The partnership itself potentially could have that obligation to pay you your money back. And, by the way, I could have individual liability for that as well. So that's where, the big danger is here is that you can have this individual liability and you can wind up being held or obligated to pay your investor back all their money, no matter what the project did, what the investment did. It's a pretty draconian result, severe result.
Now, so, and I understand, clearly, someone didn't do something right. But in this event, let's say that they screwed up setting it up initially, and they didn't follow all the rules. But let's say that they're not really, doing it with, fraudulent or malicious, intent, or even maybe even not doing it knowingly. And let's say that they're paying the investors maybe a 15% yearly return. And let's say, is there a possibility where an investor could invest $1 million, be getting, 100,000, 10% return every year, 100,000 a year for 3 years, and then say, I don't want to do this anymore, and then file this and get a rescission remedy and get the $1 million back and not netted out with the money that they may have been paid as a result of the investment doing well?
Well, I think they could be made whole, and that's assuming that there is a violation, some kind of violation happened where they could bring that suit and win. I don't think that they would ever.
Okay, got it. So the making whole would mean not, would be just you get $1 million back. You don't get the $1 million plus the 200,000 we paid you over the last 2 years or whatever.
That's right.
Okay. But, that's good to know.
In that scenario, though, that's one of those instances where you're only if things are going well, it might be pretty unusual for somebody to sue you, but who knows.
Now, if one person sues and that has the potential to maybe kind of screw over all the other investors, how do they handle that? Is it first to file just in case everyone piles in? Does it take like 50 to have some sort of a class action lawsuit? And would something like this, I can't get my F word out, but be under something like that?
Yeah, there could be issues there. I would say that probably any recovery that would be obtained. To be real honest, I'm not sure exactly. Like when you talk about first to file.
Does that matter? Let's say one person files and then other people file behind them, but it's maybe not class action at that point because maybe there are not enough people.
Yeah.
How does a judge handle that? Does he kind of group them all together? I don't know. I'm just curious. Probably doesn't happen very often, but maybe it does.
Yeah, no, there are definitely, I'm sure, securities class actions. There definitely are. And then
I see them. It seems like I see them not infrequently with publicly traded companies.
Right.
But obviously not as much with maybe someone who's just raising $10 million. Now I will say one of my neighbors, 2004, probably 2008, was getting money from other investors, and I think he was registered with the SEC, but he was basically using their monies to fund like second lien positions on high-end houses, for example, like in Lakeway, and a lot of those loans went bad, and he actually ultimately filed for bankruptcy. When he filed, he basically told the bankruptcy judge, I don't have any creditors, but a few creditors showed up at the bankruptcy hearing just because they read about it in the newspaper, I guess, and they raised their hand and they said, no, 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 I'm a creditor. And the judge basically said, what's this, what's going on here? And I guess postponed his trial. The next trial date, it was like standing room only with all of the people whose money he had taken.
Yeah.
That's kind of scary.
Yeah.
And I don't think he had the money anymore.
Yeah. No, I mean, at that point, you know, and that's, I guess, one way to, you know, take care of your individual liability is bankruptcy. And I think that probably a judgment for securities fraud is something that would be dischargeable in bankruptcy. But
you know what? I think he declared, oddly enough, I think he declared bankruptcy before any of these people came in to sue him and got a judgment. So, and I think you can only declare bankruptcy like once every few years. I don't know. It's a very interesting case. Is a very interesting case. And I mean, I knew people personally who got caught up with him and got into, you know, a serious amount of trouble. So, you know, even when you do everything right, you know, investments still go haywire.
Oh, yeah. No, that's absolutely
and I'm not saying
right.
he did everything right, because my guess is, I mean, he did all the filings correctly, but I just don't think he fulfilled his full fiduciary duty to his investors after the filings, meaning with the investments.
And then, you know, just to finish out this slide, I mean, people always talk about going to jail, and certainly you look at somebody like Bernie Madoff went to jail for securities fraud. But I would say that just if you're making good faith you know, mistakes, not actively trying to defraud somebody, you know, just the possibility of jail is probably pretty remote, but it's definitely a possibility. And then this, you know, touching on this general solicitation, don't take an ad out in the newspaper. Also, don't put something on your website. You know, we've got this great investment opportunity. We're forming a limited partnership, and you know, you can invest limited partnership interest for $10,000, whatever. Don't do that. That constitutes a general solicitation. And if you do that, then you can't. You're not eligible to use this private offering exemption, which is just, if you don't have that, the alternative is for you to go and register to become a public company, and the cost of that is just so prohibitively high. I mean, to take a company public, you're looking at tens of thousands, maybe at least $100,000 in legal fees. For simple deal. So, you know, for deals like what we're talking about, they have to be private issuance of securities, and if you have a private issuance of security, you cannot have a general solicitation. And so, just you know, giving you the definitions here, we're looking at advertisements, articles, notices, like I said, websites. If you do have, you know, let's say that you have a website, maybe you've got a blog, and you're talking about the Austin real estate market, and you know what you think is going on there, and like Shenoah, you come across deals, and you want to talk about opportunities there, investment opportunities. You can make some of this information like an offering document or maybe a partnership agreement. You could make that available to potential investors, but you need to password protect that portion of the website, and you need to qualify your investors ahead of time. And we talked before about you know, these investor qualification standards, and one of the considerations in making general solicitations is, you know, whether you have a pre-existing relationship with this person that's visiting your website for the first time, and you know, you get a call and they say, hey, I really enjoyed your blog, and you know, it looks like you maybe have some investment opportunities here. You haven't given a lot of information out, because I know that you're wanting to be careful not to make a general solicitation, but I would like to receive additional information. And so I say, okay, well, I just need to get to know you a little bit better. Maybe tell me a little bit about your background, your investment history, you know, what the types of investments that you made in the past. Are you an accredited investor? If so, then that's great. It makes it really easy for me. If you're not, are you sophisticated? I look at the Texas standards, and they're looking at ability to bear risk, and do you have sufficient disclosure of information about the deal terms. But it's only once you establish that relationship and preferably determine that the investor is accredited, would you give them this password protected access to your website where you've got all these disclosure documents about the great deal that you're putting together. And it's just kind of a long discourse on the use of websites, but just remember that a discussion forum, you see somebody saying, talking about this great opportunity that they've got, and they've hired an attorney to put together a limited partnership. Again, it's what's done in practice maybe is different from what the law technically requires. But just know that person offering those limited partnership interests on the discussion forum, they should be very careful, because they put together that partnership, and 5 years down the road, they've got these 5 partners, and something goes wrong, and those partners go to sue them. One of the complaints is going to be, they're going to go back and say, how did you find out about this investment? Oh, it was through this website. They look at the website, maybe, I guess you have to cache the history of the website, but if they can show that there was just all this information out there that wasn't password protected, and it was constitutes a general solicitation, then on the basis of that, they could maybe obtain this rescission remedy that we were talking about, and just again, maybe nothing necessarily goes wrong apart from that, but it's really important because because they engaged in a general solicitation, it wasn't eligible to be a private issuance of securities, and so they violated the securities laws. And here we're going on, this notion of use of websites, and crowdfunding is an interesting thing that you may have heard about, and the SEC hasn't issued final regulations in this area yet, but I think that what we're going to see in the future is the ability to use the internet more, and allowing entrepreneurs to raise money and giving them some freedoms that they haven't had in the past. But the rules haven't been finalized, and there's just really a lot of speculation about how exactly that's going to work out. But in the future, I think that there will be greater flexibility, and I think there are opportunities, especially for a smaller real estate investor, or a promoter, or somebody that's trying to put together deals. I think that this could be a powerful tool in the future, and hopeful that the SEC will come out with some good rules on that, and allow people to use that as a means to raise money in a way that they haven't been before.
Right.
And then also think about mass emails and mailings. If you get a list of investors and you want to do a blast email, that could constitute a general solicitation as well. This is the last slide, I think, before we really get to the end. But one thing that you'll hear about a lot is, I've got this great opportunity, and I know a lot about real estate, but I don't know that many people with money to invest. And so I go to Shenoah and I say, Shenoah, I know you know all these investors. If you bring in $1 million, I'll pay you 3% of that. I'll pay you, $30,000 on that $1 million investment, and you're going to serve kind of as a finder for me. And that's the technical term. Well, technically, Shenoah would need to be a registered broker-dealer before she could do that.
Who do I register with? Is that I would have to register with the SEC? Is there like a form or a test?
You'd have to go find like Schwab or TD Ameritrade. I mean, some broker-dealer that you would have to affiliate with.
Okay.
Take your Series 7, I guess probably 66 with that.
Which I heard is not an easy task. People study for it for months and months and months. Yeah.
That's right. And then the company, the broker-dealer, has to authorize you to sell that investment on their investment platform. So it's really not practical. And that's
going to be hard to do. I mean, who at Schwab or, any of the other places would say okay to that, though, right?
Right.
And they wouldn't want you to do it. You'd have to find someone private, and then that would present issues as well.
But again, practice and what the actual rules say. I mean, this is done all the time, and you'll see people out there that are compensated in this way. And again, violation of securities laws, and bad results can happen. So just be aware of it. And there are ways. There are some exemptions that you can take advantage of. But let's talk before you do that. Before you pay any money for helping you raise money. Pay someone to help you raise money like that. So again, OPM, important concept. I'll just leave it on this page. Definitely any other questions that Shenoah, you have, or I don't know if I can see questions that I guess.
Yeah, I think only I can see them.
Okay.
So guys listening, I hope you found this interesting. I think one of the reasons why I wanted to bring this to you guys who are on the call, as well as one of the reasons why I brought it to our real estate club, our local real estate club here in Austin, is because as the market changes, as the market heats up, there are different opportunities, and sometimes people want to get a little bit more creative, and some people know at least one person with some money and now know that they need to find other people with money so that they can actually do more investing. And actually on our club listserv, we had several investors sort of getting a little bit on the hairy edge of this, basically saying, hey, we're looking for investors, we're going to pool a group of money, we're going to raise some capital so that we can invest, in this particular project. And, for me, it's like, that's a red flag for me because I host the site, number one, but it's also a red flag for me because, geez, the guy who's asking that question may not have any idea that it's actually not something that, he or she should be doing, and they need to know because as the market turns, in an up market, you see a lot of people doing this. You very rarely see people doing this in down type markets, just because real estate is out of vogue. But now you're seeing more and more people doing it. And Roland, I'm sure you're getting more calls too. Is not just the real estate market rebounds, but just the national economic environment rebounds as well. And especially, being here in Austin, I'm sure you get a lot of, interest, business, etc., because this is such, a creative, town, and people are, putting together ventures all the time. So as, as you get more creative, and even in fact, as you grow your business, this is something that you're going to probably want to consider. And that's one of the reasons why I wanted to bring it up to those of you that are on the phone, as well as, those who will listen to it later as a recorded call. This is an area of growth. This is an area of potential. My guess is, a lot of these funds, and I'm curious, Roland, to ask you, my guess is maybe a lot of these funds are getting maybe a 20% return, and maybe only returning 10% to the investors and keeping 10% for themselves. What do you typically see for people when they're looking at these sorts of, when they're creating that blue sky picture? What are they typically saying in terms of returns? Are they saying anything, or is it all weasel language?
No. I mean, I'll have clients that give pretty specific target return numbers.
And what do those typically look like?
It just kind of depends on the deal. I think I had one client that told people that he expected, in excess of 10% year over year, and he put together the deal, and year 3 he sold it, delivered on what he told me he was going to do, and it's just, giving a good estimate of what you think the investment's actually, how it's going to perform, and
when you're advising people on that, do you typically tell them to water it down?
I tell them that obviously if I can tell you that you're going to make 15% year-over-year return, that's going to get your attention. And if
Absolutely.
I can back that up, if I can back that up, then I say, yeah, go for it. But just make sure know that you're creating, again, managing expectations. And if they've got a rationale for that, an explanation, this is exactly why we think we're going to be able to do that. But I tell people, it's under promise and over perform.
Right.
But
I mean, one thing that would scare me personally about this is, let's say that you get all this money together, and let's say that you can't find a deal or a deal worth doing, and now you've got to, you've set an expectation to return a certain amount of money that you haven't even touched or invested.
Right.
I mean, do you see that happen, occasionally or frequently?
Yeah, sure. And that's one thing that I've had a couple of clients do. It's happened to them where they'll put together a fund to invest in an opportunity, and for whatever reason it doesn't work out, and they'll say, we're going to invest your money within this time period after taking it, or else we're going to give it back to you, and might say without interest.
Okay.
But
okay.
That's possible. It's just defining it up front. If you're willing to pay somebody like me to put all the documents together, and it turns out that it's not a deal that you're going to do, you just tell people what it is that you're going to be doing with their money, and you give it back to them, and don't have much cause for complaint.
Because, my fear right now in today's market, because the market is so tight, that it is hard to invest, occasionally, and sometimes you have a lot of money sitting around that you're not personally investing, and other times you are out looking for money, but you can't always manage that flow, and that seems like it could open up some, not liability, but some performance issues versus what you discussed in your, marketing plan.
Right. And I've had.
So you would say you would address that as in the marketing plan, or at least in the overall documentation.
Oh, right. As one of the risk factors might be that, if you're running a fund, for instance, and you're going to sell an asset, you might not distribute all of that cash back to your investors, and you want to reinvest it, but you can't find an opportunity. You might tell people, look, we want to be a good steward of your money, so we're going to put that at least in a money market so that you're going to get some kind of return on your investment. Something that's highly liquid that we can access readily, but it's just not going to be sitting there earning no interest. So.
And my guess is you also put in some provision for, giving, we were going to buy this, and it was going to take us, 5 years to get it ready, get it tenanted, get it, move it from a Class B to a Class C, and then resell it. But we got, an offer immediately, and we can all make, even more than what I told you I was going to return to you. So I'm going to give you, not only all your money back, but everything that I told you, you were going to get in terms of gains. My guess is you'll also have investors who are like, no, that's a major tax implication for me, and I don't want it back right now.
Yeah, that's right. And that might be something that you include in as a risk factor. You say that management retains discretion to manage the assets in a way that it sees is in the best interests of all the limited partners in the partnership. And so you have to think about, well, maybe one of the investors doesn't want all that gain in year one, but if I'm making this huge investment return right up front, then, but I mean, it's just a risk, and that's one of the things that you disclose, that I have the ability to steward your money. I'm the manager of this asset, and I have the discretion to sell that if I think that that's in the best interest of the partnership. But it's also one of the deal terms that you can define. You could say that you're going to have to go out to all the investors before you sell the asset. You're going to have to obtain approval of that would probably be pretty unusual. A majority of the investors before you sell an asset, but that could be something that you do to protect yourself.
Oh my gosh, couldn't imagine getting all that done or getting that approval done. So I know for me personally, as a real estate investor and as someone who's kind of a public figure in the community, that sometimes I get deals brought to me before people do them, and they'll say, hey, take a look at this. What do you think? And probably, more than half the time I say, oh my gosh, don't do that deal. But other times I get people will bring me deals and they're like, yeah, we're already in the middle of this deal and something has gone terribly wrong. So Shenoah, now, I need your help. So what percentage of your clients are clients that have, screwed something up and are now coming to you for to fix it and for legal advice, versus what percentage of your clients are coming to you up front and saying, let's make sure we get all the I's, dotted and T's crossed?
Yeah, I would say that maybe about half and half, and the clients that you like the best are the ones that come to you and say, look, you're the expert, tell us what to do here. And then the ones that are the hardest wind up probably costing themselves a lot more money than if they would just come to me first, are the ones that try to do it themselves. I doubt that I'm unusual. Most attorneys probably really do have interests of their clients at heart and aren't just trying to rack up fees. But I think paying for good legal counsel is worth the money, especially in this area.
Oh, absolutely, yeah.
And so you think about talking with an attorney early and in the process and really trying to make sure that you're doing everything you can. Because it's just the potential for your individual personal liability is so great that it's just a risk that you can take some steps to guard against, but it does cost a little bit of money in attorney's fees, unfortunately.
Yeah, no, I'm sure. I mean, I sometimes feel like I am a Google attorney, and I create a lot of stuff myself, and I probably, get into the gray and sometimes create opportunities to get myself into trouble. However, the one thing that I definitely always do right is always try to manage the expectations of anybody else that I'm working with, which I think is really, more than anything else, probably one of the most important things. But on something like this, where you do hear about people going to jail for doing, for really committing fraud, but the forms, the regulations, the agreements, the disclosures, you really want to work with someone who's been there, had the experience of doing it, litigated it, you learned probably a lot during litigation, and just having your experience. I mean, just even that story, the title company story was shocking, but now you've got that experience, and that has probably made you an even better attorney. And this is an area of law that I highly, highly, highly recommend you guys talk to someone like Roland or Roland himself, because Roland, you can, correct me on this, because I know you've said you've helped people who have set up Delaware and Nevada corporations, but you can help people all over the country.
Yeah, and you have to think about being authorized to practice law in the different states. But I do represent people from out of state, and we'd have to take a look at the circumstances of each deal on a case-by-case basis. I mean, if you're out of state, if you're in Texas, it's really no problem, but I always want to make sure I give good value to people, and mostly, it's thinking about making sure that I'm not going to have to call up a Colorado lawyer and say, look, I'm not a Colorado attorney, I need help, and we're going to double bill the client for your work and mine, and just making sure it's efficient. But I can represent out-of-state clients, and I'll think about the issue about unauthorized practice of law and being licensed. But I definitely can help people out of state as well, outside of Texas.
Right. Okay, well, good. That's helpful. Well, guys, Roland's contact information is here. He actually gave you his cell phone, so guard that closely. He doesn't know that we've got several hundred people that could now call him on his cell phone, but his cell phone number, just in case you're listening to the audio of this, is 512-299-0509, and his his email address is Roland, ROLAND, at rpwlegal.com. So if this is something that you're considering and you're serious about it, and you've maybe already got the investment, or maybe already know investors, ring up Roland. But if it's something that you just want to pick his brain on but are not really serious, then go and Google stuff. Don't bother Roland, because I know he's very busy, and he's been super gracious with his time, both presenting at our Real Estate Investor Club as well as presenting to you guys on the line and the folks that will listen to it later on via audio and video. So Roland, again, thank you so much for your time tonight. Thank you so much for sharing with my students. I really, really appreciate it, and I know that they do too. And you've got all my contact info, so please let me know if there's anything ever that I can do for you.
Oh, well, thank you, Shenoah. It's been great. I hope it's been helpful, and I just would tell everybody, please feel free to contact me. There, no stupid questions, right?
Okay. Well, there you go, guys. Well, thank you guys so much, and that's it for tonight. So have a great evening. Roland, again, thank you, and we'll talk to you soon.
Okay. Thanks, Shenoah.
Bye-bye. Okay, guys, I'm going to make me the presenter again. Excuse me, make me the presenter again. Let's see if I can do this. Make presenter. So, guys, I hope you enjoyed that interview with Roland. He's a smart guy. I mean, he's a brilliant guy. He's got both the book and school cred. Plus he's had the experience. You want to work with someone who's actually litigated, and that's something that he's actually done. So again, a great person to have on your team. And with that, everyone, thank you for your time and have a great night. Thank you for being on the Love American Homes coaching call.